Thanks very much, Francis. Well, yes, it does include us. We have had bouts of positive trading on the JSE today, but also dipping into negative territory as well. Right now, we're sort of seeing the all-share index having eased somewhat. But generally speaking, in Europe, we've been seeing markets there in positive territory. And as you say, that all has to do with the narrative that there's an expectation that while the US Fed will raise rates, it won't be in September, but further down the line. And locally, we see that the rand remains on the back foot. It's heading towards the 14.50 against the dollar level as it did yesterday. Whether it will touch it or not, well, that remains to be seen. And we saw earlier today that DRD Gold came out with positive financial results. However, their results were not exactly as shiny as other perhaps bigger counters like your Goldfields and Anglo Gold Ashanti. Let's take a look at the indicators. Well, I'm joined by Lee Riley. He's from IG South Africa. Thank you very much for joining us.
Thanks for having me.
As always, good stuff. Yesterday's markets were somewhat subdued, but today we're seeing a turn in tone. What's changed?
Well, I think first thing to note is obviously the slightly subdued volumes, and there was a bank holiday in the UK yesterday. US had a fairly strong evening last night. Bank index in particular finished up quite strong. So that spilled over into our local markets this morning, and also there wasn't a lot of data over these first 2 days in the week. We've got a very, very data heavy week going into Wednesday, Thursday, and then on to Friday. Lots of PMI numbers coming out of specifically the UK market manufacturing and the construction PMI. And then Friday is the non-farm payrolls, and these are two very, very big data points. Obviously, with the UK after Brexit, wanting to check the health of the economy in the United Kingdom, and then US with commentary around the Fed and talks about rate hikes again, to see how much of that information the market's going to digest, and then make assumptions of whether we're going to get 1 or 2 or 0 over the next 3 or 4 months of what's left of this year.
Some people in the market suggest that perhaps there was a bit too much excitement around Brexit. Would you agree with that?
Too much excitement. I think the excitement came on the back end of the fact that it was unexpected. I think everything had been priced into the Remain, even in the days before we were sitting here talking about it. And I think what it meant or what it means for the UK exiting the EU, and still the fact that there's still a lot that needs to be sorted out, and the lack of surety of what's actually going to take place has been the biggest concern. Definitely has been a knee-jerk reaction. We've seen a lot of recovery after that. Pound isn't anywhere near where it was previously, so there is still quite a lot that's got to unfold in the market after that.
Indeed. Now, you talked about a currency. Let's talk about our very own, the rand, on a back foot still. To what extent is that being influenced by exogenous factors like what's happening in the US and the fact that the dollar is generally stronger, and obviously domestic factors as well?
I think if you wanted to really quantify it from a numerical point of view, you would have to work out the dollar versus the other basket of currencies in the dollar index, and then the rand relative to the dollar in that scape. But I think the combination of the hawkish commentary from the Fed, but then the very conservative commentary from Yellen saying that these hikes are going to be gradual, it has led to a little bit of a drain in terms of our volumes, and particularly in emerging markets, in equities and in bonds. But obviously, naturally, the local things that are taking place here, be it around Eskom or SAA or around the Hawks circling Praveen Gordhan, that obviously creates a lot of fear in our market. And all the good that was done in the lead up to a month ago has very, very quickly been undone by what's been taking place, and it creates a very volatile situation. I think, as you said earlier, I think 1450 does tend to be a bit of a cusp for us. I think if we break 1450, we're going to very quickly be going back to 15.
I think you've touched on it already, but it really was my next question to say, for potential investors who are looking at what's happening in South Africa, what does this type of scenario do for investor confidence and obviously the actions that follow?
Yeah, I think you've got to look at it in two ways. Would you be going and investing in parastatals? Probably not. We can unravel them and take them apart in any way, which way you like. But it certainly looks like that the governance of them and the way that a couple of these parastatals are butting heads with the likes of the Treasury, it doesn't make it attractive. It does mean, though, that there are a whole lot more opportunities on our local bourse with listed companies that you can invest in. So I think it's just about being picky and maintaining a bit of common sense and composure when you're looking at investing locally. But it does create some issues around our leadership and the type of qualities that our leadership are displaying.
Okay, let's take a quick look at DRD Gold. As I mentioned earlier, they came out with headline earnings per share up 28% for the year ended June. However, I say that their results were not as shiny as the bigger stocks, Gold Fields, Anglo Gold Ashanti, whose HEPS rose by several 100%. Why is that the case?
I think it's maybe not coming off as low as much of a lower base as some of the other shares have. They've also been fairly consistent. However, they are in a different kind of mining as well. And at the moment, if you look at the resource counters, a lot of them are also going sideways. They've been quite a strong consolidation for the last sort of 2 or 3 weeks or so. So maybe not the pick of the litter in terms of timing with getting this information to market. We've seen the commodity prices pull back as well, so not exactly the greatest time if you were going to look at a share and buying into it to look at the results and go, they're great, okay, let's buy up DRD. However, they are off a bit of a technical reversal at the highs, and certainly at these levels, if you're a technician and you're looking at entry prices, it does look like a good entry for the share price. So I don't think it's a bad buy. Quite often the shares that are less talked about by analysts are the ones that you need to keep an eye on.
And as a trader, when you look at the underlying gold commodity itself, would you put your money in there, given that obviously it's still seen as a safe haven asset when we're in a risk-off mode?
I think you need to be cautious because with all the talk around the Fed, there's an inverse relationship that exists between commodity prices and the US dollar. So when interest rates may tend to hike, it seems like we're leaning towards more of a may tend to hike in the United States, then we might see a bit of an asset flush out of other assets. So moving out of equities, moving out of gold counters, and moving into the US dollar. But numbers like those that are going to come from the non-farm payrolls become very important because it's a barometer for how healthy the US market is, and including the UK PMI numbers as well. And if that's the case, then we could probably see a little buying in the dollar, a little bit of buying in some other equities. But unless there's more fear in global equity markets, then we might find that commodities tend to go sideways for a little while now.
Okay, thanks very much, Lee. We always appreciate your time.
Thank you.
That was Lee Riley. He's from IG South Africa. After the break, Francis has more business news for you.